10-year treasury yields moved lower this week. Recall we closed last Friday at around 2.5%. We opened Monday, we saw yields go as high as 2.55. Then over the course of the week, slide all the way down to 230 yesterday, and then today we saw them creeping higher, ending the week around 238. So about 12 basis point decline week over week. But it was a big slide from the high to the low after we saw that big move higher throughout first quarter. So again, seeing a modest decline in yields this week from 250 down to 238 to end the week after we saw stronger than expected non-farm payroll number, after we continue to get stronger inflation data. And yes, the Fed is still expected to raise rates more aggressively in 2022 with the next rate hike coming as early as May. And it looks like it could be a 50 basis point rate hike according to Fed Fund futures. So at this point, right now, a lot of things happening in the market, but we did see 10-year note yields decline week over week, again, down 12 basis points to about 238 to end the week. Now, what does this all mean for volatility? Well, if you check out that CVOL index over at cmegroup.com, you'll notice that volatility had been sliding lower this week as well as yields were moving lower. And that's a directionality we've seen, a relationship we've seen between volatility and yields in the past. It's kind of gone by the wayside a little bit as things got a little dicey and volatility was going higher as risks were rising. But again, this week we saw things go back to the norms. We saw yields moving lower. We also saw volatility moving lower as well. Lastly, let's talk about those yield curves and the indications that they may bring and what they mean. Over the course of the last several weeks, we've seen a number of yield curves go inverted, meaning that the longer dated yield is lower than the shorter dated yield. And at this point, things like the 5-7 yield curve, the 5s 10s, the 7s 10s, all over the last several weeks. This week, we saw 2s 10s, 5s 30s, and 2s 30s. So these are significant because when those flip to be inverted, they are a signal that a recession is likely coming. Not tomorrow, not the next day, but likely over the next 20 to 24 months. But it is an indication of a recession coming. And while the Federal Reserve is looking to raise rates and normalize policy, that's not what they want as their headwind, is a potential recession down the road. So a lot for the Fed to figure out there, but those yield curves do tell the tale of the tape. And right now, they're not painting a pretty picture of where they think the economy is going. So opening up second quarter, we see 10-year note yields, after sliding lower most of the week, nudge higher to close out the week around 238. Next week, we have FOMC minutes, a number of Fed speakers, but we don't get any real inflation data or significant data that the Fed will be watching until the second week of April.